Your emergency fund is probably costing you thousands of dollars right now, whether you know it or not. The safe money sitting in your savings account is actually getting destroyed by inflation every single day. And most people have no idea it's happening. In the next few minutes, I'm going to show you exactly how inflation is impacting every dollar you own. Your cash, your investments, your debt, and more importantly, the specific strategies I use with my clients to turn inflation from a wealth destroyer into a wealth builder. We'll cover why some investments actually thrive during inflation, how debt can become your best friend in an inflationary environment, and the 3 immediate actions you can take today to protect your purchasing power. I'm Bob Wolfe, certified financial planner and IRS enrolled agent with nearly a decade of experience working with the top 1% all the way down to those individuals who have invested in their future education with the privilege of taking on hundreds of thousands of student loan debt. But before we dive in, this content is strictly educational and should not be interpreted as specific investment advice. So now let's talk about what inflation really is, because most people think it's just about prices going up. But here's what I've learned over the years. Inflation isn't just about prices rising, it's about your money's purchasing power falling. But let's get to where this really hurts. Your cash holdings and your safe assets. This is where I have to deliver some tough news for most families. If you have money sitting in a traditional savings account earning a whopping 0.1%, while inflation runs at 3%, you are losing 2.9% of your purchasing power every year. On $10,000, that's $290 gone, just for keeping your money safe. That is the peace of mind tax. Here's a real example from my practice. I had someone who had saved $200,000 for a house down payment. She had kept it in savings for 2 years while house hunting. During that time, inflation averaged about 3.5%. I had to show her that $200,000 now had the purchasing power of about $186,000. She had lost $14,000 in purchasing power by playing it safe. And it's not just your emergency fund. Fixed incomes get destroyed by inflation. I work with plenty of individuals who carefully plan budgets, stretch thinner and thinner every single year. I'm talking pensions and annuities. Social Security is an outlier since it's one of the only fixed income sources that actually has a cost of living adjustment for inflation every year. Said another way, their pension payments stay the same while everything costs more every year. Now, how inflation transforms your debt. The hidden opportunity. This is where inflation gets interesting, and it's not something most people can easily wrap their heads around until it's explained. Inflation can actually be your best friend if you have the right kind of debt. When you borrow money at a fixed interest rate, you're paying back that loan with dollars that are actually worth less over time. Think about your mortgage or any sort of debt where your payments stay the same. But as inflation rises, that payment represents a smaller portion of your real income and net worth. Let me give you a concrete example. I have worked with somebody who has a $400,000 mortgage at 3% fixed interest rate. Now, I know that's not where we are right now, but if inflation runs at 4%, that mortgage is essentially paying itself down in real terms after inflation. That bank is getting paid back for dollars that are worth less than when they lent them out. Same thing holds true if your mortgage rate is at 7% or your interest rate is at 6%. It is the difference from that percentage minus inflation gets you to your real after the erosion of inflation effect on your debt. But here's the flip side, and this is crucial. Variable rate debt like credit cards and adjustable rate mortgages become dangerous during inflation. When inflation spikes, the Federal Reserve raises interest rates, generally speaking, to combat that and throw cold water on the economy. So your variable debt gets more expensive precisely when your dollars are worth less. It's a brutal double hit. I was working with somebody who had $50,000 in variable rate debt when rates started climbing. We immediately developed the strategy to convert as much of that as possible to fixed rates before it got worse. Now let's talk about your investments, because inflation creates very clear winners and losers in your portfolio. The biggest losers, cash and traditional bonds. We've already covered cash, but bonds get hit hard too. When inflation rises, interest rates typically follow, and this pushes bond prices down. A bond paying 2% becomes much less attractive when new bonds are paying 4%. Here's how it works. Let's say you own a bond that's paying 3%. If inflation pushes rates up and new bonds are paying 5%, nobody wants your 3% bond at full price. The market value drops. I've seen bond portfolios lose 10 to 20% of their value during inflationary periods because of this. Fixed income investments like CDs that seem safe can actually guarantee you lose your purchasing power after inflation. One piece here for those who have sizable bond portfolios to help combat the rising interest rates or inflation that's rising is to be shortening the duration of the bonds in their portfolio so that they don't get hit quite as hard by the time that those bonds roll off and mature within the portfolio, so that the value of the bonds behave a lot more the way that you would think bonds would behave. Much more secure and much less volatile. An example of how this affects bonds is that in 2022, very recently, the Bloomberg Barclays Aggregate Bond Index was down almost 15% from its highs as a result of a rising interest rate environment to try to throw cold water on inflation rearing its ugly head. This is where people who had very conservative portfolios typically ended up getting hit on the chin with the decrease in the value of their bonds going from a stable amount 1 year to down 15% seemingly overnight. Real estate has historically been an excellent inflation hedge. Property values and rents tend to rise with inflation while your fixed mortgage payments stay the same. I have clients who've built serious wealth this way. Their properties appreciate with inflation while their debt gets cheaper in real terms. Stocks also can thrive during moderate inflation, especially companies with pricing power. I look for businesses that can easily pass costs to consumers without hurting demand. Think consumer staples, healthcare, certain technology companies. These companies can maintain profit margins even as prices rise. But here is what's crucial. Having the right mix and understanding how these assets interact during different inflationary environments. So how do you protect yourself? Here are 5 specific strategies I've used with my clients. Number 1, minimize cash beyond your emergency fund, and anything beyond 3 to 6 months of expenses, keep in a high yield savings account to combat the eroding costs. Put everything else at work. I typically recommend online banks like Ally or Marcus that can pay competitive rates, but even that's just damage control. Second, invest in real assets. I allocate portions of clients' portfolios to real estate in real estate investment trusts, and this is also on top of stocks of companies that have increasing purchasing power and sometimes commodity exposure. It's important to also understand that those homeowners of us have a large portion of our asset base that is in real estate and equity within our property. Albeit not diversified, it's still helping as a real asset. A $10,000 investment growing at 10% annually becomes just shy of $26,000 in 10 years, and that crushes inflation in most scenarios. Stocks do a good job at combating inflation. Third, lock in fixed cost where possible. Fixed rate mortgages, long-term contracts, even prepaying certain expenses can protect you from rising costs. Fourth, diversify your income streams. Multiple income sources provides resilience. I've worked with people who have developed rental income, dividend income, business income, different sources that respond differently to inflation. Fifth, consider inflation protected securities. I bonds were a hit when COVID reared its ugly inflation head. Treasury inflation protected securities, or TIPS for short, are also ways to help leverage the costs of inflation to your benefit. They're not exciting, but they do exactly what they say they'll do. And a tactical bond strategy that most people won't tell you. If you believe inflation will spike and rates will rise, to combat it, as mentioned, buy shorter duration bonds. This lets you reinvest at higher rates later since they won't be maturing in 20 or 30 years, but 3 or 5 years. Conversely, if you think inflation is peaking and will decrease, you can always try to lock in higher rates for longer periods of time. This is relatively tactical, so you should be carefully planning for that. But I use this strategy with people during the recent rate environment. For those who locked in 5% rates for longer periods of time are sitting pretty now. Now let's talk about what you can do today. Here are 3 immediate actions. Number 1, review your expenses from the last year and identify where inflation has hit you hardest. This awareness helps you budget and invest more strategically. Number 2, move excess cash to high-yield accounts or investments. Every day you wait, inflation is eating your lunch. Number 3, reconsider aggressively paying down low-interest debt. If your mortgage is below 4% and inflation is above that, you might be better off investing the extra payments. Bottom line, inflation affects everyone, but it doesn't have to destroy your financial future. The wealthy understand these concepts and position themselves accordingly. Now, you do too. The greatest risk isn't making the wrong investment. It's not investing at all and letting inflation silently erode your wealth. Cash guarantees you lose purchasing power over time. By understanding how inflation affects different parts of your financial life and taking these strategic steps, you can transform this economic challenge into an opportunity to build real wealth. If this helped you understand inflation's real impact on your money, hit that like button and subscribe for more insights that typically only the top 1% have access to. Drop a comment with your questions about inflation or other financial topics you'd like me to cover. And until next time, I'm Bob Wolfe, helping you build wealth using strategies that actually work in the real world.